Decline of 20% in stock price in a single day, nearly 60% drop over 3 years, reduced revenue and profits, loss of market share. What happened to Nike? What explains Nike's decline? In this video, you'll understand what happened to Nike's stock and why the company faces a major challenge just a few years after its peak. Nike, the multi-billion-dollar giant created by Phil Knight and Bill Bowerman, conquered the world actions that made it number one not only in the athletic footwear market, but also in the sportswear sector as a whole. Its dominance is so great that Nike has become a symbol of pop culture and is closely linked to various sports and personalities like Ronaldo, Michael Jordan, and Tiger Woods. Moreover, Nike has gained fans worldwide with its diverse footwear, creating a culture of its own, the sneakers. All this atmosphere of products, stars, and stories created a multi-billion-dollar business that peaked in 2021, especially after consumers from various countries fueled the sneaker market, with prices rising as stores worldwide reopened. Nike rode a wave of prosperity that seemed to chart a successful path, but later revealed a series of mistakes. To understand the problem that hit Nike, we need to go back to 2020 when the company got a new CEO, John Donahoe. The new leader had no experience in the fashion sector or any sports-related business. His background was in technology. He had been CEO of eBay, one of the largest e-commerce sites in the world. This was the reason for his hire. Historically, Nike operates as follows. The headquarters designs and creates clothing and footwear models, which are produced by outsourced factories and then distributed to 3 sales fronts. The first of these are wholesalers, stores that buy large volumes of Nike products at a discounted price and resell them to the public, adding their profit margin. These stores can resell to consumers or smaller retailers, including large stores and distributors. The second are Nike's own stores, run by the company and selling to the public at prices similar to licensed stores. But since they are owned by Nike, the profit from the final price also goes to the manufacturer, making this channel more profitable than the first. The third is e-commerce, managed by Nike itself. The company's online sales occur through its website and app, often at similar or lower prices than the other 2 channels, with much higher profitability since it eliminates all the costs associated with physical stores and can often deliver directly from the factory without passing through a distribution center. This is by far the most profitable mode. With this in mind, the new CEO's role was to focus Nike on where it could make much more profit: e-commerce. The bet, even in January 2020, was that in a few years, people would stop buying in physical stores and shop exclusively online. Nike was restructured to make e-commerce its main channel. Over the years, Nike not only developed an app to support this plan but also 4 others, all aiming to strengthen the relationship and increase the average ticket from various types of customers. Besides fostering brand loyalty, the apps offer benefits and discounts that encourage customers to buy via the app instead of physical stores. Alongside, Nike made a highly controversial decision to sever ties with some of its major historical partners, eliminating many wholesalers that sold its products in physical stores and online, including the traditional Macy's with megastores across the US and Zappos, the largest online shoe retailer in America. The break showed Nike was determined to control its product distribution to gradually eliminate physical retail and operate primarily online. This foundation was crucial for what came next. With the pandemic, physical stores worldwide closed, and initially, people didn't need new products when they could barely leave their homes. However, in 2021, as businesses reopened globally and massive financial injections into the economies of most countries occurred, customers flocked to Nike products, and the company recorded its best year in history, with tremendous success in e-commerce, which came to represent a quarter of all sales. This trend led the financial market to believe Nike had found a formula to render physical retail obsolete and would soon become a profitability machine. Optimism pushed the company's stock to a record high of over $178, following a record revenue of over $41 billion. Not only was Nike favored, but a global market for its sneakers also emerged, a multi-million-dollar sector with resellers trading these shoes for hundreds of dollars. Sneakers, essentially older models with new colors and additions, gained popularity worldwide, acquiring significant value through a legion of fans and the addition of stories and milestones, such as a replica of the first model worn by Michael Jordan in the 80s. These shoes, sold for around $150, could fetch 10 times more in the secondary market due to their limited editions, often collected as art pieces by enthusiasts, with some even customized by artists for added value. This led Nike to discover a new way to profit, flooding the market with sneakers. This strategy became the company's focus, launching sneakers in different colors and editions as a reason to charge more and increase profits. Even as prices rose, both in the official and secondary markets, people kept buying. Thus, Nike entered a safe zone focused on profitability. The problem was that what seemed like a glorious future turned out to be a major trap. Over time, market dynamics changed, and Nike's key assets began to fade. One of Nike's great strengths is its athlete partnerships. However, some athletes realized the market was too big and the Nike partnership had become too small for them. Today, athletes don't need a brand to profit. They can have their brand or partner with smaller brands and help them grow. This trend has led athletes to prefer more money for major contracts or to take risks with other ventures, potentially earning even more. This complicates Nike's relationship with its stars. This shift is part of a larger trend. Big brands no longer have a monopoly on industrial production. For decades, the key advantage of Nike was producing its shoes at minimal cost in Asian countries. Today, anyone can order a batch of shoes directly from a manufacturer via platforms like Alibaba. This change allows many companies to produce their shoe lines, or even for a customer to order custom shoes without a big brand. This creates a great paradox. While the internet and e-commerce were significant assets for Nike in 2021, they can also be a huge problem, as the company faces competition and piracy, sometimes even from factories that also serve the company but divert products online. On top of this issue, Nike faced other problems. Focusing on e-commerce, the company believed that consumer behavior had changed permanently and that physical stores were on their way out. The problem was that as reopening occurred, people returned to shopping in physical stores, especially those offering more attractive prices, like competitors' products. Many Nike shoes were seen as too expensive, and often, customers preferred a cheaper competitor's similar product over a pricey Nike. While almost everything has become more expensive in recent years, some Nike models' prices have multiplied due to inflation and internal perceptions that the brand could charge more, similar to the auto industry's pricing power. Meanwhile, as Nike focused on older models with different colors and editions, seeking maximum profitability, competitors began promoting different models and introducing innovations. Besides new colors and models, like sneakers, Nike began to struggle with strong competition in its main niche, which has more room for innovation: running shoes. Here, Nike has been losing ground to brands like On Running and Hoka, which attract customers globally with distinct models and proprietary technologies that stand out and innovate. As a result, Nike became not only expensive but also less innovative for customers. Adding to this, the market didn't foresee another issue: consumer hunger. In 2021, the belief was that people would spend much more on everything and pay over $1,000 for shoes without major restrictions. The reality has been different in recent months. Even Nike has acknowledged expecting a demand drop in the coming months. This trend isn't unique to the shoe market and has also affected other companies that soared in 2021 but are now experiencing significant drops in valuation. For instance, Nike shares, which peaked at over $178 in November 2021, are now trading around $72 after losing 20% in a single day following news that the company expects a sales decline in the coming months. Did the market overreact to Nike's prospects, or did the company take the wrong path? What's your opinion? This situation has led Nike to reconsider its strategies. Many partner stores that had been sidelined have resumed relations with Nike, returning to selling its products in their physical stores after Nike regretted the split. Similarly, the giant plans to place more emphasis on its physical stores, recognizing that the anticipated shift has not occurred. Additionally, Nike has announced an increased focus on innovations, recently introducing the Pegasus 41 model, its response to competitors in the running market. Furthermore, the company signed a notable partnership with the German football team, which ended a historic partnership with Adidas. For now, Nike still reaps the benefits of its history, but things could change, and a warning sign is already flashing. With around $51 billion in revenue, the giant posted about $5.7 billion in profit. These numbers are slightly higher than the previous year, but already indicate a slight decline in sales. Today, Nike earns $51 billion, while Adidas, in second place, earns about $23 billion. Nike still leads the market, with 38% market share. However, forecasts are well below earlier expectations, especially due to a possible consumption drop in the Chinese market. In this scenario, the question arises, is the concern about Nike exaggerated, or was the optimism too high? What do you think? Was Nike overvalued, or is this just the start of a major decline? Share your thoughts with us.